When Elon Musk bought Twitter, he didn't take out a mortgage. He pledged $44 billion worth of Tesla's shares and borrowed against them. That's the strategy, and it's called buy, borrow, die. This strategy works well in America and will be difficult to achieve here in Canada. I'm going to show you 3 ways billionaires actually repay these loans, and none of them involves a salary. Dividend incomes cover the interest, so the loan just sits there. Refinancing lets them take a new loan to retire the old one and roll the debt forward for years. And when they do sell assets, it's only when tax timing works in their favor. Once you understand how each path works, the whole thing starts to make sense. Hi, Kane again. I was a struggling artist that graduated from theater school with nothing. 20 years later, I own properties throughout Ontario. You can watch my full biography video to see my challenges. Also, read the references in the description below to see where I've pulled this information from. If there are any discrepancies, let me know. The information is only for educational purposes. Please consult with a licensed professional before making any investments. Without further ado, let's get started. So, a billionaire wants to buy a $50 million private jet, and the question they're actually asking isn't whether they can afford it. The question is whether they should sell stock or borrow against it, because those two choices produce completely different tax bills at the end of the year. That one question, sell or borrow, is the whole game. Here's how the borrowing side works in an overly simplified story. A billionaire walks into Goldman Sachs or Morgan Stanley and says, "Here are $500 million worth of shares. I want a line of credit against them." They look at the collateral sitting right there in the account and say yes. No pay stubs needed. No income verification, because the shares are the security. Income doesn't matter when the loan is backed by something they can price every single day the market is open. Banks typically lend somewhere between 50 to 70% of whatever the collateral is worth. So on a $500 million in stock, the billionaire pulls out somewhere between $250 to $300 million in cash, which lands in their account without the IRS touching it. The reason the IRS doesn't touch it is because there's a repayment obligation attached to the money. And under the tax code, a loan with a repayment obligation isn't income. No sales happened, no gain was realized, nothing gets reported. ProPublica found that the top 25 wealthiest Americans ran a true tax rate of about 3.4% on their growing wealth, using strategies like this, while a typical middle-class earner can lose close to 95% of their wealth to taxes, interest, and fees combined. Now, flip it around and look at what happens if they sold that same stock instead. If those shares were bought years ago at $10 each, then they're now worth $500 million. Their capital gains on the sale is enormous, and the federal capital gains tax alone could run $80 to $100 million depending on the rate and the state. So, the loan doesn't just solve the liquidity problem. It skips a tax bill that would be bigger than most people's entire net worth. The first repayment path is dividend income, though this one doesn't work for everyone. A billionaire sitting on a large portfolio might collect $10 to $30 million a year just in dividends from the shares they already own, and that cash flow covers the interest without touching the principal at all. But founders like Bezos, Musk, and Page hold stocks in companies that don't pay dividends because Amazon, Google, and Tesla keeps cash inside the business for growth instead of distributing it. So those founders rely on the overall growth of their wealth and strategic structural maneuvers to address the interest. The second path is refinancing. Instead of paying the loan off, the billionaire takes a new loan against the same collateral or against the collateral that's now worth more because the stock went up, and uses that new loan to retire the old one. The debt rolls forward and shares never get sold, and the whole cycle starts again for years or decades. The third path is a strategic sale, meaning they do eventually sell something, but only when the timing works. Maybe there are losses in another position to cancel out the gain, or the estate plan calls for it years in advance, so the tax hit isn't a surprise. Risk shows up when the stock drops hard. banks send a margin call demanding more collateral, or they'll start liquidating the pledged shares themselves to protect the loan. And for high net worth borrowers, if the portfolio breaches the maintenance requirement, often around 25%, the bank can auto-liquidate without warning. That forced sale creates exactly the capital gains event the whole strategy was built to avoid. Canadian investors can access a similar version of this through a home equity line of credit where the asset does the borrowing work instead of your income. But the terms are tighter, and Canada doesn't have a step up in basis. In the US, when a billionaire dies, the cost basis on their shares resets to the current market value, which wipes out decades of embedded capital gains. In Canada, the CRA treats death as a deemed deposition, meaning your assets are considered sold at fair market value the moment you pass away, and the estate pays tax on every gain that built up over your lifetime. That changed the risk of calculation for this strategy considerably. The whole system runs on one rule: don't sell what's growing, borrow against it instead, because the interest on a loan is cheaper than the tax bill on the sale, and the asset keeps compounding while the debt just sits there. And because the stock market is historically growing faster than the interest rate on those loans, these billionaires end up richer even while they owe the bank hundreds of millions of dollars. If you're building a real estate portfolio in Canada, a HELOC or portfolio line works the same way at a smaller scale. So think about your property as collateral first and income second. Make sure you understand what a margin call actually does, because a collateral drop forces a sale, and that forced sale triggers the exact tax hit you borrowed to avoid. In Canada, that risk compounds at death because the CRA treats your assets as sold as fair market value. So the estate pays capital gains on every dollar of growth you never actually collected. If you've enjoyed this video, be sure to watch the next one on how wealthy families protect themselves against a lawsuit. Thanks for watching.